Hi everyone. Today we're going to talk about government bonds. There's a famous quote circulating on Wall Street, supposedly from James Carville, a political consultant from the Clinton era. He said, "If I were to be reincarnated, I'd want to come back as the bond market, because then I could scare the hell out of everyone." So, what exactly is this seemingly unremarkable government bond? To understand government bonds, we only need to understand one of the oldest relationships between people: borrowing money. Imagine you come home and find your spendthrift Uncle Sam sitting on your couch. He looks a little worried. He says, "Hey buddy, I want to build a highway, or I want to build a new aircraft carrier, or maybe I even want to give every household some relief money. But I'm short on cash, and the taxes haven't come in yet. Can you lend me some money?" You might hesitate. Why should I lend you money? To reassure you, Uncle Sam pulls a piece of paper from his pocket and writes 3 lines on it. Face value, $1,000, meaning I'm borrowing $1,000 from you now. Maturity date, 10 years later, meaning I'll return this $1,000 to you in 10 years. Coupon rate, 4%, meaning, to thank you, I'll pay you $40 in interest every year for these 10 years, without fail. This piece of paper is a government bond. So, a government bond is essentially an IOU from the government to you. In European and American markets, especially in the US, this IOU is divided into different categories. Those borrowed for a few weeks are called T-bills, those borrowed for a few years are called T-notes, and those borrowed for 20 or 30 years are called T-bonds. But no matter the name, the logic is the same. You give cash to the government, and the government gives you a piece of paper promising to repay the money and pay interest in the future. At this point, you might ask, so what? I get interest when I deposit money in the bank, don't I? And I can get even higher interest rates with corporate bonds. That's true. However, government bonds possess a superpower that no other borrower has risk-free status, making them the cornerstone of global finance. Note that this doesn't mean they are absolutely risk-free, but rather that, within the rules of finance, a country with monetary sovereignty like the United States can simply order its central bank, the Federal Reserve, to print money to repay its debts if it can't otherwise pay them back. If even the U.S. government can't repay its debts, it means the world has likely collapsed. At that point, the money you have in the bank, the stocks you own, and the cash in your safe deposit box would all become worthless. Therefore, government bonds are considered the safest asset in the financial world, the gravitational pull for all investment returns. If government bonds were simply bought and then stashed under the mattress, waiting to collect interest every year, they would indeed be quite boring and certainly wouldn't be enough to scare Wall Street. The real magic happens in a place called the secondary market. There's an interesting concept. The price and yield of government bonds move in opposite directions. Let's use the previous example. You're holding that IOU from Uncle Sam that says $1,000, 4% interest. Suddenly, one day, the Federal Reserve announces an interest rate hike, or people think the economy is overheating, and the interest rate on newly issued government bonds increases. Now, Uncle Sam is borrowing money again, but this time the new IOU he's offering is face value $1,000, 6% interest. At this point, if you urgently need money and want to sell your old 4% interest IOU to your neighbor, Mr. Wang isn't a fool. He says, "Hey buddy, don't try to fool me. Newly issued government bonds now pay $60 in interest every year. Your old one only pays $40 a year. Why would I buy your old one at the original price of $1,000? You have no choice. To sell the old IOU, you have to offer a discount. You say, okay, how about I sell you this $1,000 face value IOU for $900? Mr. Wang does the math. If I buy it for $900, although the annual interest is still $40, because my cost is lower, and the government will still repay the principal of $1,000 after 10 years, my actual return on investment will be higher, roughly equivalent to the current 6%. Deal. Because the new bonds are more profitable, the price of your old bond must fall for someone to buy it. The reverse is also true. If the Federal Reserve lowers interest rates, you can then raise the price to $1,100 or $1,200 and sell it. This is also the source of countless joys and sorrows on Wall Street. Next, let's talk about why government bonds can predict economic crises. You may often hear the term inverted yield curve in the news. What does this mean? The normal curve should be low interest rates for short-term government bonds and high interest rates for long-term government bonds. But sometimes a strange phenomenon occurs. The interest rate on short-term government bonds, for example, 2-year bonds, is actually higher than that of long-term government bonds. This indicates that investors are thinking, the current economic situation is terrible. I think an economic recession is imminent. When the recession comes, the central bank will definitely cut interest rates to stimulate the economy. So I would rather lock in that 3% interest rate for 10 years, because I think the average interest rate over the next 10 years might be even less than 3%. Therefore, everyone frantically buys long-term government bonds to hedge against risk, driving up the price of long-term government bonds and lowering their yield. At the same time, they sell short-term assets. This is an inverted yield curve. In the past few decades, almost every time before an economic recession in the United States, whether it was the dot-com bubble of 2000 or the financial crisis of 2008, the government bond yield curve has inverted. At this point, you might ask, okay, but I'm just an ordinary person living in the suburbs, working a 9-to-5 job, and I don't trade bonds. How does this affect me? It affects you a great deal. First, there's your mortgage. In the U.S., the interest rate on a 30-year fixed-rate mortgage basically follows the 10-year Treasury yield. Once government bond yields rise, money will be withdrawn from the stock market and flow back into the bond market, causing a stock market crash. This also explains why technology stocks fell so dramatically when the Federal Reserve raised interest rates in 2022. Finally, there's your purchasing power. When U.S. government bond interest rates are high, money from all over the world, Europe, Japan, the Middle East, will be converted into U.S. dollars to buy U.S. bonds, which will push up the dollar exchange rate. If you like to travel abroad, you'll find your dollars are worth more. But for American export companies, this could be a disaster. After discussing so many principles and potential risks, I'm curious. Do you currently have government bonds in your investment portfolio? Or do you think they're too conservative and you're fully invested in stocks? Feel free to let me know in the comments section, and let's discuss it together.